What you're looking at here is the sort of broad stock market performance. The chart kind of looks busy, but it's pretty simple. Every bar is a quarter. The blue bars are where the S&P 500 have positive returns, and the red ones are the ones that it didn't. So this is actually a monthly return. So looking at the last three bars here, we can see the quarter ended for the most part, as I mentioned earlier, negative 4.3 to be specific. Now, when I say the weakest start of since 2022, I want to put that in the context. We had really strong 3 years, as highlighted in our last town hall. We've had annualized return of about 23% over the last 3-year window. The markets don't do that forever, right? So a 4% pullback after a 3-year double-digit gain might feel jarring, but it's not unusual. And we'll come back to that idea a little bit later in the deck. The two numbers here that tell us what happened mostly in this quarter. First, on the left-hand side, you see an index called Russell 1000 Growth Index. That's just kind of fancy way of saying large cap growth stocks. In this particular quarter was almost 10%. That index is dominated by the Mag 7 that people usually refer to, companies like Microsoft, Nvidia, Apple, Tesla, and a handful of others. After 3 years of AI enthusiasm, those names had very extreme valuations, and that's where the market had a lot to give, right? So when the turbulence comes in, the companies or the sleeves of the market that have run up, that's going to be where they take the most shock. On the right-hand side, you saw about almost 25% increase in a commodity total return index. This index is dominated by energy and commodities, and this quarter, we saw energy stocks soar because of the oil prices went up significantly. Gold, which is sort of a safe haven asset, also went above 5,000 per ounce. Why? Because of the conflict, because of uncertainty, which started in late February. Oil as well as energy-related stocks, as mentioned, went up as well. The takeaway is that the AI-led narrow leadership in the few past years or quarters sort of broke down in this quarter, although since the beginning of August, we've actually seen a reversal of that. We didn't escape the quarter unscathed. The diversification helped. Some of those decisions that I mentioned earlier at the late year that we had made, they helped. To be clear, we're not saying that tech is over, but it should never be that you should never own a growth stock again or anything like that. But we're saying that the concentration in these names continue to be a risk, especially when things become choppy. They're going to be the ones that give the most.